This analysis report argues that VALE SA, ticker VALE, is a strong buy.
Right.
It bases its case on what it calls extremely low valuation metrics, a massive dividend yield, and, exposure to some big macro catalysts like China and the green transition.
And that focus is instantly compelling. I mean, it hits all the right notes. Deep value, huge yield, future-facing metals.
Yeah.
The data they lead with, that 10.44 PE and the 10.53% yield, it just immediately establishes that deep value premise.
It does. It asks a great question right up front. Is this stock just too cheap to ignore?
Exactly. So let's dive right in. Let's see how we can turn what is a really strong start into a truly impenetrable investment thesis. And I think that starts with confronting risk head-on.
Okay, so our first area then, the analysis report needs to integrate a much more robust risk profile to strengthen the overall credibility of its strong buy conclusion.
And you could see the energy, right? You see the clear pitch that this stock has been, unfairly put in that value trap box.
Exactly. The material makes a strong case that, look, the volatility in iron ore prices is the main fear scaring investors away.
And the argument is that the worst-case scenario is already priced in.
Right. But here's the problem. The current analysis, it doesn't structurally analyze the other major risks, the operational, the financial, or, the geopolitical risks that come with a massive global mining operation headquartered in Brazil.
And that omission, it creates a significant credibility gap. It leaves the whole bullish case feeling a little insulated from, real-world complexity.
Yeah, it does.
The report is basically saying it's cheap because of risk, but then it kind of fails to prove it fully understands the depth of that risk. And that ultimately undermines the whole valuation thesis.
It's the classic tightrope block when you're analyzing a cyclical commodity miner, isn't it?
Absolutely.
You get that low PE because the market is terrified of the risk, the unseen or maybe the unquantified risk. And if the analyst doesn't address those fears directly, the conviction just starts to crumble.
I wonder, though, do you think they felt that focusing on those historical operational hurdles would just distract from the forward-looking, the green transition part of the thesis?
That's a fair question, but I think if you omit the very thing that's causing the market's psychological scar, you fail to justify why that low multiple is wrong.
Right.
Focusing solely on the PE and the dividend, it kind of overlooks the resilience you need to actually navigate resource extraction.
So the suggestion is what then?
Well, the analysis should dedicate a whole structured section to these potential headwinds, address them head on, and then, and this is the key part, explain why the current valuation of, $13.21 still discounts those systemic risks appropriately.
You need to demonstrate the resilience, not just assert it. So, yeah, the suggestion is don't shy away from the known dangers. Use the company's current position to neutralize them in the argument.
Precisely. For example, instead of just mentioning general iron ore volatility, include a brief analysis of the cash flow sensitivity.
What happens to the cash flow if the price changes?
Yeah, what happens below a critical threshold? How sustainable is that massive dividend of iron ore falls, say, 20 or 30% from where it is now? We need to see the safety mechanism that's built into the balance sheet.
And it's not just the price of the commodity. It's the cost of extraction, the cost of operation.
Of course.
You need to broaden that context beyond simple price cycles. Discuss the company's past operational hurdles, the jurisdictional stability issues, the scars that the market actually remembers.
And then, crucially, show how VALE's current financial structure or its diversification into nickel and copper provides a real buffer against those known challenges.
That diversification piece is the key lever here, I think.
It is. It should be presented as a proactive rebuttal. Use that move into future tech metals, the nickel, the copper, to explicitly mitigate the historical, cyclical, and geopolitical risks from their main iron ore business.
And that shift in narrative, it totally transforms the risk section from just like a list of liabilities into a strategic advantage for the whole strong buy case.
If the analyst can show us with tangible data that even under significant stress, like say iron ore at $80 a ton and some adverse Brazilian court ruling,
right,
that VALE still remains free cash flow positive and the dividend is only, partially adjusted, then that $13 valuation really starts to look like a genuine discount.
But until then, the market just sees a low multiple that's probably justified.
Exactly. Okay, let's pivot to the income play, which they rightly highlight as, the headline grabber.
That massive dividend.
To fully justify that 10.53% dividend as a massive safety net, the report has to provide a deeper analysis of its historical sustainability and its future coverage.
Okay, so what I really like about this section is the clear focus on that number, 10.53%. I mean, they note it's nearly 8 times the S&P 500 average.
It's a siren call for income investors, for sure.
It is, but the analysis, it almost treats this high dividend yield as a guaranteed return. It assumes that, as long as iron ore stays above break-even levels, the payout looks attractive.
And that oversimplification, it risks confusing what is fundamentally a cyclical cash return with like a stable fixed income instrument.
That is the danger with commodity stocks, isn't it? The yield is just the face value. It's the free cash flow, the FCF. That's the actual engine size under the hood. That's what tells you how long that face value can last.
Exactly. When you're assessing deep value, the PE tells you about historical cheapness. The FCF tells you about financial robustness today.
That makes sense. But couldn't the evidence also support a different conclusion? I mean, couldn't it show the dividend is actually highly vulnerable to cyclical swings rather than acting as a safety net?
It could, which is why the analysis needs to move beyond just that simple yield percentage. It has to incorporate an analysis of the FCF yield and what management's specific stated payout ratio targets are. That's how you prove durability.
In commodities, FCF generation is everything.
Everything.
If that FCF is super volatile, then that 10.53% yield is really just a snapshot in time. A snapshot taken at a cyclical high point.
And it's not an enduring feature that you can build a long-term strong buy thesis on, not for an income investor anyway.
So we need to see the mechanism of safety, not just the attractive number itself. The suggestion then is to quantify the cushion.
Yes, quantify the cushion. I like that. Specifically, you could reference the FCF generation against their, roughly $56 billion market cap?
And that would demonstrate the depth of cash that's actually available for distribution.
Right. How large is the margin of safety, in dollar terms, that's backing the cash flow they mention? It needs to be crystal clear that the cash being generated is multiples of what's required to service that dividend, even in a downturn.
And that's what transitions the dividend from just a tempting percentage to a quantifiable commitment that's backed by real cash flow.
And we need context for management's behavior, too. To prove that management is truly aggressive about returning capital, which is a key phrase in the analysis, they should contrast the dividend payout against metrics like, say, adjusted EBITDA or net income over the last several quarters.
Show that consistency.
Exactly. Compare the consistency of that payout against their peers, companies like BHP or Rio Tinto.
That comparison would provide some essential context for the income play beyond just the headline percentage.
It would prove this payout philosophy is, institutional and strategic, not just accidental or a one-off event because prices are high.
And if we can see that VALE prioritizes capital return more consistently than its peers, even through those cyclical whipsaws, then that income thesis gains some serious momentum.
It's all about convincing the reader that this yield is driven by policy and massive underlying cash generation, not just by commodity prices.
Right. Okay, let's look at the section on technical analysis.
Let's do it. The transition here, from deep value fundamentals and these long-term macro trends to specific short-term technical price targets, it just feels disjointed. And I think it weakens the conviction of the long-term investment thesis.
The report makes a very strong case for VALE as a long-term deep value play. It's focusing on these huge, multi-year macro shifts.
China stimulus, the green transition.
Right, and that rock-bottom PE. That sets a time horizon of years.
Then, all of a sudden, it just abruptly shifts gears. It starts discussing technical analysis markers, like the 1360 resistance level and the 1250 support level.
And it concludes that if we clear 1362, it's blue skies toward $15.
Yeah, and that rapid shift, it just completely interrupts the long-term investment horizon. It essentially turns a deep value case into a near-term trading signal.
It does. I wonder if they're trying to appeal to two different audiences at once. The fundamental value investor and the short-term momentum trader.
And in the process, they maybe just confused both. The two ideas just feel structurally out of sync.
They are relevant data points for sure, but their role needs to be clarified. If the investment horizon is long-term, specific price targets for the next few weeks are, frankly, irrelevant. They just muddy the waters. So the suggestion is that the analysis should use the chart patterns to confirm the validity of the fundamental argument.
Exactly.
Reinforce the idea that the market is finally waking up and recognizing the underlying deep value instead of just setting some specific trading targets.
Yes, you use the technical data not to plot a profit-taking level, but to prove the psychological turning point in investor sentiment towards the stock. It shows that the narrative has shifted and the stock is beginning its recovery.
Okay, so let's get actionable here. How do they actually tie those signals together?
All right, for some concrete examples. Instead of positioning the technical section primarily around trading targets, they could use the recovery trend from the 52-week low. What was it, $8.06?
Something like that, yeah.
Use that trend to visually reinforce the fundamental claim that the market seems to have priced in the worst-case scenario already.
That's smart. The chart itself validates the core premise that the risk to reward is incredibly skewed to the upside. The chart pattern becomes evidence of deep value recognition.
And then you rephrase that key breakout signal. They should frame the break above 1362 not as a trigger for a trade, but as the final confirmation that the company is exiting that value trap category people are afraid of.
So it's the visual signal that the stock is beginning to trade back in line with its established, highly profitable assets.
Precisely. It becomes a confirmation signal for the long-term holder, which aligns the technical flow with the fundamental conviction.
So they're basically saying, wait for this break to confirm you aren't catching a falling knife, and then hold on, because the fundamentals are sound.
And that unified approach, it strengthens the entire strong buy conviction by making the analysis intellectually consistent across all its timeframes.
Okay, that makes a lot of sense.
This analysis report, it has high-quality raw data and a really compelling narrative.